I think all roads lead to volume when you look at it. Whether it's risk on, whether it's risk off, whether people are chasing the hottest thing on their screen or quietly hiding in something boring, sooner or later you run into the same question. Who's really there? And how fast are they moving? Because price can lie for a while. Volume is harder to fake. Welcome back. Today is Wednesday, February 11th. We're going to slow down and separate signal from noise. And we're going to do it the same way you'd figure out what's happening in a crowded room. Not by staring at the loudest person, by watching the exits. I've got a guest with me today who spends his life inside market structure, flow, and the plumbing that nobody wants to read about until something breaks. We'll call him Dan. Dan, thanks for being here. Thanks, John. Ag, always good to sit down and talk through what's happening instead of just reacting to the last candle. All right, Dan, let's set the stage. So here's how I want to run this, because if we don't organize it, it turns into a bunch of spicy sound bites and no one learns anything. We're going to use 3 clocks. Clock 1 is the household clock, what people are buying, what people are postponing, what bills are getting paid first. Clock 2 is the corporate clock. What big companies are building, how they're funding it, and how long they're willing to commit. Clock 3 is the trading clock. What's happening minute to minute? Who's forced to buy? Who's forced to sell? Who's just churning risk, like a DJ mixing the same song all night? And when those clocks are in sync, the world feels normal. When they drift, you get the weirdest headline combo imaginable. Everything is fine on one screen. Everything is tight on the other. And that's the environment where silver can suddenly become the loudest instrument in the orchestra. Let's start with clock 1 because people love to skip the household piece and jump straight to charts. But households are the ground. Households are where demand starts, and demand is where earnings end up. Here's what I'm seeing in plain English. A lot of families are not cutting everything. They're not eating rice in the dark. They're still living life, but they're doing the quiet stuff. They're swapping brands. They're shrinking the cart. They're delaying the new appliance. They're saying, not this month, to the bigger upgrades. And you can see it in how spending shifts. When times are easy, people buy the optional things. When times are tight, people buy the necessary things. And they bargain hunt on everything else. And the part that matters for markets is what happens next. Because once the swap brands phase runs its course, the next phase isn't buy a different brand. It's don't buy it. And that's where you start seeing corporate revenue disappointments show up where nobody expects them. Now, layer in the payment side. In the last couple of years, a lot of households leaned on credit. Not because they wanted to, because they had to. You don't have to be a genius to understand this. If your monthly essentials jump and your paycheck doesn't jump the same way, you bridge the gap somehow. At first, that looks fine. Resilient consumer. But then the math catches up. Minimum payments rise, rates reset, auto insurance jumps, rent renews higher, and suddenly the bridge becomes a permanent road. That's why delinquencies drifting up matters. It's not the apocalypse. It's a warning label. It tells you the financial system is absorbing friction. And friction is the thing markets hate most, because friction slows velocity. Okay, now clock 2, corporate America. This is where the story gets funny, because the corporate clock is not one clock. It's 2 clocks stacked on top of each other. One clock is the average company. They're watching demand. They're watching costs. They're trying to protect margins. They're trimming here and there. They're not trying to be heroes. The other clock is the handful of mega platforms that basically operate like small countries. And right now, that second clock is the one making the noise. The AI build-out has turned into a physical build-out. And I want people to really hear that. This is not just code. This is not just we updated the app. This is warehouses full of servers. This is power contracts. This is cooling. This is fiber. This is racks and chips and transformers. And when companies are building at that scale, they start looking at the bond market the way regular people look at a mortgage. They're saying, give me time, give me certainty, let me lock this in. From recent market updates, we've already seen big issuers leaning into that. And forecasts for corporate bond supply this year are not small. They're in that multiple trillions neighborhood, with a lot of it tied to refinancing needs and big capex plans. Now, here's the connection to metals. When you build data centers, you don't just need software engineers. You need metal, you need copper, you need aluminum, you need silver in certain electronics applications, you need industrial inputs that have real supply chains. And supply chains do not care about your quarterly guidance. A mine takes years. A refinery takes years. A transformer factory doesn't scale overnight. So the corporate clock can create a demand pulse that spills over into commodities even if households are tired. And that's one reason metals are staying loud. But again, and this is important, loud doesn't mean one direction. Now, clock 3, the trading clock, this is where the abnormal signal lives. Because in a market where the average day is already in the high hundreds of billions, when you see a single ETF pull in massive share volume and options volume, you're seeing a spotlight. You're seeing attention concentrate, and concentration is always where accidents happen. Let me explain why without getting too nerdy. An ETF is not just a stock, it's also a machine. When demand surges, authorized participants can create new shares. They do that by delivering the underlying basket, and the ETF issues new shares. When demand falls, shares can be redeemed. The basket can be handed back, and the ETF shares disappear. So ETF volume can be one of two things. It can be people trading shares with each other, which is just churn. Or it can be net new exposure being created, which is more like real flow. And the scary part is the headline doesn't tell you which one it is. It just says record volume. Now add options, because options are where volume turns into obligation. When you buy calls, someone sold them to you, usually a dealer. And that dealer is not trying to be your enemy. They're trying to be neutral, so they hedge. If you buy calls, they often buy some amount of the underlying to stay hedged. If you buy puts, they often sell or buy protection. And the hedge has to change as price moves. That's why you can get this weird push-pull feeling around certain levels. It's not your imagination, it's the hedging. And when options are short-dated, the hedging is faster, more twitchy, more aggressive. So, if a silver ETF has a big options chain getting lit up, you can get price action that looks like a video game. Up fast, down fast, then up again. And every time it does that, more people notice, which brings in more options activity, which forces more hedging, which moves the underlying. It's a loop. And one more wrinkle, because people confuse a lot of trading with a lot of ownership. On some of these burst days, the chatter isn't about long-term stacking. It's about short-dated calls, quick flips, and momentum crews trying to ride away for a few hours. That matters because it changes the risk profile. If the crowd is mostly running exposure, they don't defend dips, they abandon them. So here's a test you can run in real time. Watch what happens after the first big spike. Does volume stay elevated while price holds a tighter range, like the market is digesting and building a base? Or does it turn into a saw blade? Rip, fade, until everyone's exhausted. The first pattern usually means new ownership is forming. The second pattern usually means the trade is eating itself. And when a trade starts eating itself, it doesn't announce it politely. It just snaps. Also, pay attention to how quickly the hype moves on. If the ticker trends in the morning and vanishes by afternoon, that's not a thesis. That's a flashlight in a dark hallway. Now, let's make this relatable. If you and I pass the same $100 bill back and forth and we do it 10 times, we can claim we transacted $1,000, but nobody got richer. That's turnover. So when you see crazy ETF volume, ask, is this new wealth entering, or is this the same bill being passed around by increasingly nervous hands? And here's the little twist that makes this silver story extra spicy. Silver has two identities. Gold is mostly about monetary psychology. Silver has that monetary side, but it also has an industrial side. So on days where the market wants a hedge, silver can trade like a cheaper cousin to gold. On days where the market wants excitement, silver can trade like a levered bet. And on days where the market wants liquidity, silver can trade like an ATM. That mix is why it attracts big volume bursts. Now, I want to bring up something fresh that's been hiding in plain sight. When people talk about metals, they talk about inflation hedge like it's one word. But the last couple of years taught investors something uncomfortable. Inflation can fall, and markets can still be fragile. Growth can slow, and markets can still be fragile. Rates can pause, and markets can still be fragile. Fragility isn't just inflation. Fragility is debt plus speed. That's why even with inflation cooler than it was at the peak, you still see these stress behaviors. Short-dated options dominating, record turnover, and sudden rotations into anything with a compelling narrative. And silver has a compelling narrative in a single sentence, like Dan said. Now let's layer in gold for a moment, because it matters. We've had multiple years in a row where official sector gold demand has been huge. Again, north of 1,000 tons a year, which is a massive number in that market. That's not a day trader story. That's a we don't fully trust the system story. Now, does that guarantee silver is next? No. But it does create an environment where precious metals are not treated like a joke, the way they were in some earlier periods. And when that's true, a silver ETF can become a lightning rod for flows, especially when the dollar wobbles or rates drift lower. Now, I also want to mention platinum, because it's the quiet cousin that people forget until it starts moving. Platinum's story is more supply chain and industry specific, but when inventories get tight, any incremental demand can move price. And when one metal moves, traders start playing the catch-up game. That's how rotations spread. First it's gold, then silver, then something like platinum, then copper, then suddenly everyone is an expert. So if you're watching this and thinking, okay, John Ag, what do I do with this? Here's what you do. You stop treating volume as applause. Volume can be applause. Volume can also be panic breathing. You look for confirmation in behavior. Does silver hold up on a genuine risk-off day? Do spreads blow out? Does the dollar spike? Does stocks sell off? And if that happens, does silver act like protection, or does it act like a trade that gets dumped? That tells you what it is in that moment, because silver can switch masks. And the people who get hurt are the ones who assume the mask never changes. Now, Dan, I want to get a little uncomfortable. What's the biggest misconception retail viewers have about record volume days? They think it means smart money is buying. Sometimes it does, but a lot of the time it means the market is recycling risk. And the most active instruments are the ones that allow that recycling. It's like a highway. A traffic jam doesn't mean the destination is popular. It can mean there's an accident ahead. Perfect. Traffic is not the destination. Traffic is the condition. And that's why this abnormal silver ETF volume is worth respecting, because it might be telling you the market wants optionality. The market wants leverage. The market wants something that moves. And when the market wants that, it usually means confidence is not as stable as the headlines make it sound. One more cliffhanger before we keep going. If a silver ETF is soaking up that much activity, what else is being ignored? Because attention is a limited resource. When the crowd is staring at silver or AI or whatever is loud that week, something boring is usually quietly deteriorating. Sometimes it's credit, sometimes it's small caps, sometimes it's regional banks, sometimes it's the real economy in a specific pocket. The market rarely breaks where everyone is looking. It breaks where nobody is looking. Because people watching this might be thinking, why silver? Why now? And now we're going to connect the clocks to the headline. Clock 1 is telling you the average household is still standing, but a growing slice is straining. Clock 2 is telling you the biggest companies are spending like they can't afford to lose the next decade. Clock 3 is telling you traders are playing a faster game than most people realize. And somewhere in the middle, you've got silver. This weird, emotional, useful, volatile metal getting pulled into the spotlight. Now, I want to bring it back to the practical question. When a silver ETF trades abnormally high volume, is that bullish? It depends on the kind of volume. Let's put the two versions side by side again, but sharper. Healthy volume looks like this. More participation, more steady accumulation, more dip buying without chaos. Unstable volume looks like this: big spikes, fast reversals, violent mood swings, and a lot of options activity driving hedging flows. And there's one more layer people miss. A lot of ETF volume can happen even if no one is investing more, because the ETF can become a convenient instrument for hedging. If you're a trader sitting on equity exposure and you want a quick stuff happens hedge, you can trade a metal ETF fast. If you're a macro fund, you can use it as a proxy for volatility. If you're a dealer, you can use it to neutralize risk. So the ETF can become a tool, not a thesis. And that's why the volume itself is the clue, not the conclusion. Now let me zoom out for a second and talk about the broader tape. We've seen this pattern more than once. The economy sends mixed signals. The market rallies anyway, and the rally is powered by speed and positioning. Turnover in equities has been massive. Options have become shorter dated, and the buy the dip reflex is deeply wired into people's brains. But here's the uncomfortable part. A reflex is not the same thing as strength. A reflex is what you do automatically. And automatic behavior can get you hurt when the environment changes. Now, Dan, I want you to explain this next piece in human language because it's important. When the market is dominated by same-day option flows, why do we get these weird intraday whips? Because the hedging is immediate. A dealer sells options, then they buy or sell the underlying to manage risk. As price moves, the amount they need to hedge changes. So the hedging can amplify moves, especially near big levels where a lot of contracts sit. Exactly. So if you've ever stared at a chart and said, "This is ridiculous, it's like it's being pulled by magnets," that's not you going crazy, that's structure. Now add silver's personality, and you can see why volume bursts can turn into fireworks, because silver doesn't need much to move, not compared to a mega cap stock with deep liquidity. It can go quiet for a while, and then a wave of attention hits, and suddenly it's a different market. And here's the cliffhanger that matters for the next few weeks and months. If the abnormal volume in silver is mostly positioning, then the next real liquidity event in equities can turn silver into a source of cash. Not because people hate silver, because they need money. This is something people forget. When there's stress, people sell what they can sell, not what they want to sell. And a liquid metal ETF can become an ATM. So if you see a day where stocks are wobbling and silver is also wobbling, don't instantly say, "See, metals are useless." It might just be a liquidity moment. It might be a positioning cleanse. Now, let's talk about the counterpoint for a moment, because I don't want this to be one-sided. There is a world where this volume is telling you something real. Silver's industrial demand isn't a fairy tale. Electrification is real. Data centers are real. Grid upgrades are real. And the build-out isn't slowing to zero just because one economic report looks soft. And there's also a behavioral reality. A lot of people feel like the financial system is more fragile than the headlines suggest. That's why you've seen persistent interest in hard assets from gold to other commodities. So it's possible the silver ETF is becoming a broader trust barometer. When trust is high, people chase growth and ignore hedges. When trust is shaky, people start looking for alternatives. Silver sits right in that tension. But even if that's true, the path is still going to be messy, because silver is not a slow, polite asset. It's a brawler, and brawlers don't move in straight lines. Now, let's add one more thing that isn't always in the silver conversation: energy. When energy is cheap and stable, building and refining and manufacturing can expand more smoothly. When energy is tight or volatile, the cost structure for industry changes. And energy is also part of why AI build-out has become a power story. Data centers aren't just computing, they're consumption. So when you hear about power constraints, grid bottlenecks, and infrastructure spending, you should hear real economy demand in the background. That's fresh context that matters for metals. Not because it makes silver a guaranteed winner, because it makes metals a contested battleground. Okay, now I'm going to ask you something, and I want you to answer honestly. Have you ever bought something just because it was moving? Most people have. The problem is, movement feels like certainty, and certainty is addictive, but movement can be a trap. So, if you're watching the silver ETF volume spike and you're thinking, I'm late, slow down. Late is the most expensive emotion in markets, and the opposite, paralysis, can be expensive too. So, the job is not to be fearless. The job is to be precise. Know why you want exposure. Know what would make you wrong and size it so you can survive being wrong without blowing up your life. Now, I'm going to give you a simple checklist for the next time you see abnormal volume in any asset, not just silver. 1. Does the volume show up on up days, down days, or both? 2. Does price hold the move or does it revert immediately? 3. Does volatility rise with volume or does volume rise while volatility stays contained? 4. Do other risk markets confirm the move or is the asset acting alone? If it's acting alone, it might be a story trade. If it's being confirmed across the tape, it might be a regime shift. Now, Dan, I want to zoom in on something you said earlier. Don't confuse liquidity with safety. Explain that. Liquidity is the ability to trade right now. Safety is the ability to hold through stress. Something can be liquid and still be dangerous if the crowd is positioned the same way and has to exit at the same time. That's it. That's the whole lesson. Liquidity helps you enter. It doesn't guarantee you'll like the exit. Now, let me circle back to the household clock for one more beat, because it matters for what comes next. If the consumer stays in hold the line mode, companies that depend on discretionary spending can start missing expectations. If enough companies miss expectations, the market narrative shifts. And when the narrative shifts, the trading clock can change character fast. That's when you see correlations jump. That's when you see everything sells days. That's when you see people scrambling for liquidity. And on those days, the silver ETF volume can spike for a totally different reason. Not because people are buying, because people are getting out. So the trick is not just to watch volume, it's to watch the reason behind it. Now, I'm going to ask you 2 questions, and I want you to answer in the comments. First, when you see an ETF suddenly trade like that, do you personally read it as smart money rotating or fast money stampeding? Second, if you had to pick one metal to watch as the tell for market stress this year, gold, silver, or something else, what would it be? Drop your answers. I'm genuinely curious. And by the way, if you're successful, share your success story in the comments so others can stay motivated. Seriously, it helps more people than you think. All right, now let me give you 3 possible paths from here, because this is where people get trapped by one story thinking. Path 1, the volume is signaling a real shift in public interest. People are adding metals exposure broadly. The silver ETF stays liquid and dips keep getting bought. In that world, silver can grind higher over time with violent swings but a rising floor. Path 2, the volume is mostly a derivatives-driven reflex loop. A burst of excitement pulls in traders, dealers hedge, price surges, and then something changes. Maybe the dollar firms up for a bit. Maybe equities wobble. Maybe volatility spikes. And the same crowd hits the exit at once. In that world, silver can drop fast, even if the long-term story hasn't changed. Path 3 is the one that breaks the most people. Sequence: a pop, then a dump, then a bigger pop, a headline, then a reversal, then a squeeze. This is how markets punish the impatient and the overconfident, and it's especially brutal in assets where leverage is common. So, what's the big takeaway? Here it is. Volume is information, but it's not a verdict. High volume can mean conviction. High volume can also mean fragility. Your job is to figure out which one it is before you make a bet that depends on it. Because in a speed market, timing is not a detail. Timing is survival. One more thing, and I want to say this plainly. If you're watching silver because you think it's going to save you, you're approaching it wrong. No asset saves you. Risk management saves you. Position sizing saves you. Diversification saves you. And humility saves you. Silver can be part of a plan. It can also be the thing that breaks your plan if you treat it like a lottery ticket. Dan, last question. If you were coaching someone who's new to all this, what's the simplest rule you'd give them about a moment like this? Don't confuse movement with meaning, and don't confuse liquidity with safety. If you're going to own something volatile, own it in a size you can sleep with when it moves against you. That's it. And for everybody listening, if you want more breakdowns like this where we connect the economy, the tape, and the plumbing, hit subscribe and remember to comment, Our John AG, if you want to help me keep copycat channels from hijacking your feed. All right, I'll leave you with this. When a silver ETF starts trading like it's the main character, it's not just a silver story. It's a market structure story. It's a speed story. And speed can be your friend right up until the moment it isn't. And as always, this is for education. I'm sharing how I think about market signals and risk, not telling you what to buy or sell. I don't know your finances, your time horizon, or your ability to handle drawdowns. Do your own homework and consider talking with a qualified professional before acting on anything you heard.